On April 3rd, after one of the worst drops on the day after the reciprocal tariffs were announced, and then a jump back up after the 90-day pause on the tariffs were announced, major indexes still remain below their pre-tariff announcement levels. I wanted to do some research on an analysis that compares the current market fluctuations to similar episodes over the past 30 years, focusing on tariff-related events like the US-China trade war in 2018-19, as well as some other major market stress periods. Using historically data-backed evidence, we'll try to understand what is happening in the market now and the probability of what we may expect. To remind you and set the scene, the day after the reciprocal tariffs were announced on April 3rd, the S&P 500 had its worst one-day sell-off since the 2020 pandemic crash. That led to investors flocking to safe havens, including the 10-year Treasury bonds, which sent the bond yields down to below 4%, and the Japanese yen and other haven currencies strengthened. At the same time, the market's fear gauge, the VIX volatility, spiked sharply, which showed that investors were very sensitive to trade policy. Compounding the trade fears are the signals that the business cycle may be turning. The US yield curve has been inverted, which means the short-term rates are above the long-term rates for over 2 years. This is an exceptionally long period and the longest on record. An inversion is a recession predictor. In fact, a yield curve inversion has predicted every US recession since the 1970s. In the last video, I had shared that banks and economists have put an average probability of a recession between 30 to 40%. Now, the average probability predicted is around 60% after the tariff shock. Adding to that, business confidence and consumer spending are under close watch for deterioration. Some analysts believe that the tariffs could double core inflation, and that will shave off 1% of the GDP growth. This would lead to a stagflation risk. Before the tariffs, the economy was actually showing resilience with strong job growth, lower unemployment, and cooling inflation. But after the tariff shock, the Fed signaled that they will pause any rate changes and monitor the situation of the stagflation risk. In a stagflation, there is no economic growth, but there is still inflation, which can lead to weak corporate earnings, less consumer spending, and this has mixed effects on stocks. For example, energy and commodity stocks can outperform because hard assets rise with inflation. But tech and growth stocks underperform because valuations are pushed down due to higher interest rates. And if they are already overvalued or high in their valuation, then this suppression will be more pronounced. It's not guaranteed, but the stagflation conditions are ripening. For example, if the US-China trade war persists and the 90-day pause on tariffs end without a relief on the reciprocal tariffs that were mentioned, then stagflation will continue. What we will see is that in the near term, volatility will stay elevated. VIX will likely continue to be over 30. Market rallies will start to dwindle. In the next 1 to 3 years, PE multiples will be compressed, and tech and growth stocks can underperform. But before that could happen, the Fed could act if they wanted to avoid a recession. For example, in the 1970s, stagflation impacted the stock market sideways, but the Fed raised rates sharply to break the inflation. In 2011, during the Euro debt crisis, there were mild stagflation fears, but ECB and the Fed eased policies. And a couple of years ago, the inflation peaked but growth held up, so there was no recession. And data evidence shows that this will most likely be the case this time around. In other words, in the next few months, we'll continue to see huge fluctuations and further downswings in the stock market. But by the end of 2025 or 2026, we should start to see a recovery due to economic cycle resets and policy adjustments. Now let's look at the data analysis to back this claim. The most similar parallel is in 2018, tariffs against China triggered immediate stock market sell-offs, particularly on announcement days, followed by relief rallies when negotiations resumed. Despite periods of optimism, the market remained volatile for over a year. A year into the volatility, the Fed pivoted from hiking rates to cutting them, which ultimately stabilized markets and drove the recovery. Today, we're seeing a similar pattern. An aggressive tariff shock has rattled markets, And while temporary policy pauses can spark rebounds, a full recovery may not materialize unless the tariff overhang is resolved or the Fed eases conditions. Similarly, during that time, the yield curve was also inverted and VIX was at 30. Other tariff episodes like the 1995 US-Japan auto tariff threat and the 2002 steel tariffs created sector-specific stress, but it didn't lead to broad market declines because they were narrow in scope. This contrast is important to note, though, because today's tariffs are far more broad, similar to the 2018 trade war, but it's on steroids. The implication is that unless tariffs are rolled back meaningfully, the stock market is likely to face broader and longer-lasting headwinds than in the earlier cases. In both cases, the recovery was short-lived within months, but the key was that the tariff wars were resolved or the Fed policy kicked in. Similarities from the dot-com bubble and today is that the yield curve inverted in 2000, a classic recession signal, and the market peaked shortly after, just like what we have been seeing lately. But stocks declined steadily for 2 years as earnings fell. The Fed cut rates aggressively, but recovery was slow because of the overhang of corporate excess. Today's market faces its own overhang, high valuations, and weakening growth amid tariffs. If the corporate earnings over the next few quarters show a decline in growth, then we may see similar slow decline in stocks before bottoming. Now, the global financial crisis was driven by financial system failure rather than tariffs or inflation, but one relevant similarity is the yield curve inversion again in 2006 that foreshadowed recession. Once recession hit, the market decline was steep and swift, with recovery only starting after extraordinary Fed action. If today's tariff shock triggers a recession, which the inverted yield curve suggests is possible, markets could fall below recent lows before policy intervention sparks a recovery. In 2011, the market fell nearly 20% after the US debt downgrade and Europe's debt crisis. Yet, the US avoided a recession and markets recovered within months because the Fed signaled prolonged low rates. Again, the key parallel is investor fear of policy error. If policymakers signal flexibility and avoid further escalation in tariffs, the market may stage a recovery even without a recession. In 2015 to 2016, there was a global slowdown scare, falling commodity prices, and stock market corrections. The Fed responded by pausing rate hikes, and markets rebounded within months. Again, the lesson for today is clear. Fed flexibility matters. If inflation from tariffs stays elevated, the Fed may hesitate to cut, delaying recovery. But if they pivot, history suggests markets can rebound quickly. More recently, the pandemic crash was the fastest in history, down 34% in weeks, but also saw the fastest recovery thanks to massive policy intervention. While today's shock isn't health-related or at this global scale, the volatility spike and investor fear mirror 2020. If we want to see a similar recovery and bottoming of the market, the key is the same. We need to see either a fast resolution to the tariff war or aggressive Fed easing, which could again produce a sharp recovery. And finally, comparing to the 2022 cycle, aggressive Fed rate hikes to combat inflation caused a bear market. The yield curve inverted for a record length like today. The recovery only began after inflation cooled and the Fed paused hikes. This suggests that in 2025, unless inflation pressures from tariffs subside or the Fed pivots, the market may remain volatile and range-bound. What does all this data tell us about the future outlook? Will we experience a further decline or recovery? Based on the evidence of economic indicators of today compared to notable events in history, the current conditions tilt more toward further decline in the near term of months because the presence of a serious recession predictor, i.e. the inverted yield curve, and the tightening financial conditions, which can't be ignored. Unless there is a swift de-escalation of the trade conflict, here's a likely scenario based on evidence of past patterns. In spring-summer 2025, we see an ongoing volatility as trade negotiations unfold over the next 90 days. We may see big swings like we saw in the last 2 weeks, but importantly, they would most likely be bounded within a range. Then, in late 2025, if tariffs that were announced on April 2nd remain in place, and a recession is more likely, then corporate earnings will likely decline, and the stock market might break below the downswing from last week, entering a bear market. By early 2026, the Fed will have to act. Inflation will start to stabilize, the economy will start to respond to the stimulus, and the stock market will likely enter a bull market. Again, it's important to note that this is just a likely scenario if the tariff war does not resolve. If the trade war is resolved without a broad recession, then we'll see a soft landing scenario and the market will recover without reaching a lower bottom than the lows of last week, as early as late 2025. The final thing I want to mention is one indicator to watch over the next few weeks to determine if the market is bottoming, which is market momentum. Currently, there's lack of evidence suggesting an upward momentum. For instance, the 200-day moving average is signaling a bear market. The relative strength index is indicating weakening momentum. All the momentum indicators are suggesting a downward momentum right now. While it's stressful to time the market, I'll be keeping an eye out for the momentum indicators to stock up on the fundamentally strong companies. Fundamentally strong companies are ones that have a clear path to growth, have a strong pipeline of customers, they're profitable and have cash and no debt, among many other traits I look at. As you know from my past videos, Palantir and Nvidia are fundamentally strong companies that will go up after the uncertainties stabilize. I hope this was helpful. Please let me know in the comments or with a like if you like this kind of content. And feel free to suggest what content you would like to see in terms of macro indicators or company-specific analysis. Thanks for watching.